I'm pleased to welcome my first guest today, Keith Derman, partner and co-head of infrastructure opportunities at Ares Management. Over the past 2 decades, the Ares infrastructure team has deployed over $16 billion across more than 350 assets and companies. Keith, thanks so much for joining me today.
Thanks for having me.
It's great to see you, and I'm so excited to have this conversation today about infrastructure. Feels like it's always topical. We always need infrastructure, but I feel like it's particularly timely today given the new administration and given, I would say, very prominent investor focus on it as well. So tell us, why has the asset class attracted as much attention as it has? Why has it grown so much?
I've been an investor in the industry for 20 years now, and when I first got into the sector and we would talk to investors, they didn't know how to categorize us or classify us. And they would say, are you private equity, or are you natural resources, or maybe you're real estate? And over time that changed. And I think the real big moment was the global financial crisis. Investors were watching maybe the real estate market melt down a little bit, and they were seeing that infrastructure could still get deals done.
Yeah.
There was transaction activity, financings, and the attributes of infrastructure that are so attractive, the lack of correlation to the public markets, the inflation hedge, the income opportunities, the capital appreciation. Investors are drawn to that. That's a great part of anyone's portfolio. And so I really see the GFC as having been that big moment where maybe the sector began to take off.
Yes, and investors are clearly drawn to it because today, when I look at the assets under management and private infrastructure funds, it's $1 trillion. And we're not stopping there because when you look at the forecast, the trillion is forecast to go to $2.3 trillion by 2030. That's the forecast, but do you subscribe to that?
I certainly do. We need to invest in the historical, traditional segments of infrastructure just to keep things moving, whether that's highways and airports and roads and ports. But there's this modern wave of new infrastructure, and that's the evolution of the transportation industry. That is the renewable sector. That's continued growth in the power sector. That is the data center opportunity.
Right. And you mentioned the infrastructure investing gap. It is believed to be $15 trillion cumulatively by 2030 is what we would collectively need to spend to actually close that gap. I'm not so sure it's going to come from the governments given the constrained budget deficits. But let's talk about the opportunities. You've spelled out some of them, but where do you today at Ares find the best opportunities within infrastructure?
We are investing in all of the segments of infrastructure, whether it's transportation, social, energy, utilities, power, digital infrastructure. The highest volume of opportunities today that we're seeing really is in the data center markets. This feels like a generational investment opportunity. We're seeing project after project getting announced and getting contracts. So that allows it to attract capital. We see continued growth in the renewable sector, and we're seeing a resurgence of interest in gas generation to continue to support growth in electricity demand.
Let's talk about data centers specifically because, yes, seems to be this critical moment where we really need a lot of data center capacity, but at the same time, it's been a theme for probably the last, 10, 15 years. So have we not built enough? Are the projections not high enough? Do you still think there's upside to be had in data centers?
I think the slope of the forward curve has changed meaningfully. Right? We've been building data centers for a while as we've been digitizing our society, but then along comes AI. And now the data centers that are getting built, they're no longer 10 megawatts or 20 megawatts, right? And the key thing here is that when we talk about the size of data centers, that's power sector nomenclature. How much electricity does it use? Now we're talking about data centers that are 100 megawatts, 500 megawatts, even a gigawatt of power. It's a complete, paradigm shift in how big these data centers are. They're going to power this AI revolution. When does that slow down? We haven't seen it yet. You have, in particular, 4 really big buyers of data centers, and that's Microsoft, Meta, Google, Amazon that are, demanding these data centers, signing contracts for them. So I think it's going to continue. Ares believes it's going to continue. The market believes it's going to continue. Those companies are being rewarded in the public equity markets for investing in this industry. So it's likely to continue, I think, for some time.
And of course, that means it's the different types of computing power that needs to be put into it. And it's a different type of power requirement to actually make sure those data centers are running. So let's talk about that. And there's two ways to generate electricity, which is renewables and kind of the traditional fossil fuels. And the new administration is going to take obviously a very different stance towards renewables than the past administration has taken. There's been a lot of deals that have been done around sustainable renewable infrastructure. So what happens to those deals, and do you still see an opportunity in renewables going forward?
We do, right? We need to take stock of the new administration and some of the executive orders that have come out recently. But what we've always said was that there are 3 Ps that drive the growth in renewables, and it's price, policy, and preference. And the price is, right, the cost of renewables. And the reality is wind and solar are the lowest cost forms of electricity generation, even on an unsubsidized basis. So even without the tax credit. Then you've got the policy support from federal and state government. And then you've got the preference. And that's the demand from corporations, in particular, the 4 big tech companies that I mentioned before. That's been the biggest driver over the last few years.
So it sounds like that trend is still going to continue because of some of those Ps. But the first executive orders that was signed by the administration was to declare the national energy emergency and really trying to, not that it needed reviving per se, because oil and gas production is already running at all-time highs, but really trying to further support domestic oil and gas production and presumably power generation that uses those gas-powered power plants. So how big of a focus and an opportunity will this be for you at Ares?
It's a huge opportunity. You need to have molecules coming out of the ground and getting moved to the markets, and energy demand is growing. But ultimately, right, what I think the new administration is going to be saying is that they've got to focus on low-cost energy, they've got to focus on energy security, and they've got to focus on national security. And that means domestic production, but it also means harnessing our resources. When you think about, our vast land and the wind and the solar, it has to be part of the solution, much the way we were saying a few years ago during the Biden administration that was so focused on climate, that gas still had to be part of the solution, right? That it was a transition fuel. The transition may have gotten longer because energy demand is going up, but we'll continue to move in that direction.
Right. So Keith, it certainly sounds like there's a lot to do in all these various parts of infrastructure. And, to help us kind of sum this up for our audiences, infrastructure is a familiar asset class, but maybe there's still some misunderstandings about it. Like, what do you think private clients perhaps misunderstand about infra today?
I think that private clients tend to think it's a new investment opportunity. And I would say it is anything but. It is the basis and the building blocks of our society and our economy. We tend to only notice the infrastructure when it doesn't work, right? When something breaks down or reliability is compromised. And I think that sort of underappreciation in our daily lives has probably led to an element of underappreciation with our wallets and some underallocation. And ultimately, you have an asset class that is underfunded, which means capital needs to flow, that can command long-term contracts that give, annuity cash flow streams and income that provide an inflation hedge that are uncorrelated to the public markets, providing essential services, capital appreciation. When I think about that, I want that in my portfolio, and I think other investors should as well.
That's right. Well, that's why it is a key consideration, and that's why it's such a topical conversation for today. Infrastructure is certainly not a new, but rather a true and tried asset class. And Keith, thank you so much for dispelling some of those misunderstandings and also telling us what's going to drive this $1 trillion asset class to be 2.3 by 2030. Thanks so much.
Thanks for having me.